let me just start by thanking the organizers for giving me the opportunity to tell you a little bit about experiences with the Swedish housing market and household debt and macroprudential policy. I will not at all be conceptual. There will just be data and some historical experiences. So when we talk about Swedish house prices and housing markets, it's probably good to know a little bit more about where we're coming from and where we are today. And if you look at this first chart, you can basically see that Sweden has experienced a very abrupt and strong rise in house prices over the past 20 years. There have been a couple of blips in the 90s, but if you go back to the time of the time of the crisis in the 90s in Sweden, then you look at the light blue line here, you can basically see that apartment prices in Stockholm have been rising by about 600% since the early 90s. Now, this is the strongest increase that we see in Sweden, but even if you look at single-family houses in Stockholm, which is slightly lower, it's the red line, or if you look at single-family houses in Sweden, those have also experienced very strong increases in prices. And so, the starting point for my presentation is that, I think it's fair to say that from a historical perspective, house prices in Sweden are very high at the moment. Now, to a large extent, I think we can explain this rapid rise in house prices by what some people sometimes call fundamental factors. And I want to say at once that what we mean by fundamental factors are not necessarily things that are structural. They're things that can change very rapidly. One important reason for the increase in house prices is the ever-declining user cost of housing, driven, of course, by the falling mortgage rates. Another reason why house prices have been able to rise is that property taxes have been reduced without full compensation in the same area. And at the same time, and you can see that in the right-hand chart, housing construction has been low. And I think it's interesting to look at this chart. So the black line in the right-hand chart is basically construction. Is population growth, whereas the blue and red bars are composed of different types of housing construction. So it's fair to say that the white area between the black line and the bars is basically the housing construction deficit. And if you look at that, you can basically see that there's been an enormous buildup of this housing gap over the past 20 years. In the 50s, 60s, and 70s, Sweden had a major housing construction programs, but those have essentially leveled off at the same time as Sweden has experienced quite rapid population growth. And some of you may know that by some measures, Stockholm is the fastest growing metropolitan area in Europe, even though we're coming from low levels compared to other big cities. So there are some fundamental factors that have been driving the increase in house prices, some of them more structural and some of them sort of more business cycle oriented. Now, in addition, factors that are likely to have played a role is the fact that the rental market in Sweden is quite dysfunctional. And if you look at the left chart here, it basically shows you the number of people in Stockholm that have been in queue for public housing, and that's been rising steadily. And the right-hand chart shows you, I'm not sure if you can see the numbers here, but what you can basically see that approximately the average time that you have to wait in Stockholm to get a first-hand rental contract is about 8 years. But then you'll probably be commuting for 30, 40 minutes. If you want to live in downtown Stockholm and you want to have a rental apartment, you're probably going to be waiting for 20 years. I can tell you that when I moved to Stockholm first, which was in the early 90s, I was renting an apartment from somebody who had written the apartment on her daughter's name, and her daughter was 1 year. I'm sure she's living in the apartment by now. But it's worth doing that. I mean, you have to wait a long time to get a contract. So irrespective of the fact that there are a number of factors that can explain the rise in house prices, this is, of course, the accompanying development in debt is worrying for us. and we believe it's unsustainable. Among others, because some of these fundamental factors can reverse relatively quickly. So, what has this meant for debt? Well, the increasingly higher house prices have led to a strong increase in household debt relative to disposable income over the past 20 years. We're now approximately at 180%. It is good to keep in mind when we talk about these numbers, they're at an aggregate level. There's a substantial number of households that don't have any debt at all. They live in rental apartments, or they may have been so fortunate to buy their houses in the time when they weren't costing so much as they are today, and they were actually amortizing on their loans, because today there's a substantial number of households that do not amortize on their loans. So if we look at slightly more granular data in the right-hand chart here, you can basically see that, so the red bars here are reflecting the share of households that have DTIs in a certain range. And what you can basically see that over the past 6 years, the share of households that have a DTI that is over 400% has been rising from 26% to 31% in only 6 years. And you can also see that there is a substantial share of households that are borrowing more than 6 or 7 times their disposable income. Okay, so because of differences, I want to tell you a little bit about differences in debt levels over the country. And because of these regional differences, differences in the construction of housing, but also differences in population growth and possibly differences in income growth, there's a lot of variation in the debt levels relative both to income and collateral in the country. And what we can see here is that the median DTI ratios, they're typically the highest. They're typically the highest around Stockholm, Gothenburg, and Malmö, and then in the areas where people go skiing. Well, what you can see is that changes in DTI levels, and I don't have a third chart here, but what is actually interesting to know is that the areas with the very rapid increases in DTI over the past 6 years have typically been the areas where house prices were already very high. So Gothenburg, Malmö, Stockholm, Åre, those were the areas that had high prices 6 years ago and high debt levels, and they've been continuing to increase. But at the same time, and this is something that Stefan mentioned earlier on, there are actually also areas where house prices are falling, or where DTIs are falling. So it's not an exclusive trend upwards. And that's probably related to the fact that there's a big migration into Stockholm, Gothenburg, Malmö. Okay, can also tell you something about loan-to-value ratios. So the interesting thing is, because of this upward trend in house prices, it's not true that LTVs are the highest in the areas that have the highest DTIs. And there's a very simple explanation for that. So here we see that Stockholm is not the area with the most dark blue, it's not Gothenburg, and it's not Malmö, and it's not even the skiing areas. And that's simply because of the fact that house prices have been rising so fast that people who are not switching houses, they do experience an increase in the value of the collateral. So LTVs are actually falling. And you see that here. So the areas that have very high increases in house prices, they actually have lower LTVs. I'm not going to talk about the effectiveness of LTVs, but it's obvious that when house prices are rising so quickly, then any policy that's based on LTVs is going to have its limitations, whereas policies that are driven by DTIs or LTIs are probably going to be more effective. So because of this steep increase in household debt and because of the level where interest rates are at the moment, it is important and interesting to look at, well, what would happen to the cost of mortgages for households when interest rates start rising to more long-term levels. And so what we've done is we've done a very simple back-of-the-envelope exercise using loan-level data on Swedish households. We have a big data set with every mortgage in it. And because of the fact that most Swedish households nowadays have flexible rates, it's relatively easy to calculate what the impact of an increase in interest rates would be on the cost of living for Swedish households. And so here we've basically sorted people based on the increase in their cost of living because of the raising interest rates. So if we assume that interest rates rise by 1 percentage point, there will be about 10% of the population that will experience a growth in cost of living of about 280 euros a year, per month, sorry. And there will basically be 30% of the population that will be experiencing increasing cost of over 100 euros a month. Now, these numbers are excluding your possibility to deduct interest rates, but I think in terms of doing this numerical exercise, I think it makes sense not to look at once at deductibility, because typically what you do is you make arrangements with tax authorities to deduct interest rates based on where you are at the start of the year, and then if interest rates rise over the course of the year, you make an adjustment at the end and you get a repayment. But in real time, you will not have tax deductibility for rising interest rates unless you're extremely efficient. So in the long run, these numbers are going to be reduced basically by a size 0.3. But in the short run, these are the costs that people are going to be experiencing. Okay, I need to speed up a little bit. Okay. Simple. These interest rate sensitivities, they have been rising rapidly. So 6 years ago, there were only 10% of the population would experience a rising cost of 200 euros a month. Now that's 280 euros. And this is a general phenomenon. What does it mean relative to income? I mean, so keep in mind, I'm still talking only about 1% increasing interest rates. So if interest rates rise by 1%, how big is the relative change in the cost of living for households? Well, 10% of the population, 10% of the people with a house will experience a decrease in their disposable income of 5.7%. Another 10% will experience an increase of 4.2%. So doing a quick back-of-the-envelope calculation can basically say that 20% of the mortgage holders are going to be responsible for rescheduling about 1% of disposable income once interest rates start rising by 1%. If interest rates rise by 2%, they're going to be reshuffling 2% of disposable income because they have to take care of the rise in interest rate costs. So these are substantial sensitivities. And because I'm talking too much, speed up a little bit. So these are just micro-level data from Sweden. I just want to say that there's some lessons to be learned from what happens in other countries. And here we've just collected this actually from a paper that Martin Flodén has been writing. He's collecting some data on how much did consumption change over the 5 years after the financial crisis, and been relating that to household debt. There's no causality story here. This is just a correlation. But what you do see is that countries that have relatively low debt levels tend to have relatively benign changes in consumption after the financial crisis, whereas countries as the Netherlands or Denmark, Ireland, I could mention Norway here as well, they've actually experienced bigger changes, negative changes in consumption, and had relatively higher debt levels. There are also people that have looked more structurally at these things, and I think the common lesson to be made from these studies from the UK, Denmark, and Norway are that households that have higher LTIs or DTIs tend to have bigger reductions in consumption during the financial crisis. And there's a very nice monotonicity. The quantitative sizes differ, of course. Okay, I've been talking about households, housing markets. What can we say about banks? Well, I think one interesting thing to look at is if you look at what Swedish banks looked like after the crisis in the 90s, about 20-25% of their lending consisted of mortgages. If we look at what they're doing today, they're actually about 50% of their lending consists of mortgages. And they've become a lot bigger, as you can see. And at the same time, they have a fair amount of deposit funding, but about 40% of their funding comes from bonds that are either directly or indirectly related to the value of housing and housing collateral. So banks have become mortgage banks, much more from business and household banks. Okay, well, this is simple. We have been warning about some of these things, and we're not alone. The ESRB, the IMF, and the OECD, and even the European Commission have have warned about the risk of high household debt. It's interesting to look a little bit at what has been done in Sweden. As Stefan mentioned, it's the FSA, Finansinspektionen, who has prime responsibility for macroprudential policy. We talk about this in the Financial Stability Council, where the National Debt Office, which is the resolution authority, and we and the Ministry of Finance are represented. But these are the policies that have essentially been implemented. In 2010, an LTV was introduced with reference to consumer protection. So this is not a strictly binding policy, even though it has been implemented, but it is not legally binding. Risk weight floors on mortgages have been introduced. Countercyclical capital buffer has been raised gradually to 2%. And then last year, an amortization requirement was introduced, where households now can borrow. When they take a mortgage, they can borrow a maximum of 85%. Between 85 and 70%, they have to amortize at a 2% rate per year until they reach 70%. And then after that, they have to amortize at a 1% rate at the minimum until they reach a 50% level. Now, this is a very dotty graph, but I think there's one thing that's actually it's kind of nice to see. So this is data from 2015, so this is pre the amortization requirement. Every dot is a loan, and a loan-to-value ratio and a debt-to-income ratio. And what you see is that there's a lot of normalization around the 85% LTV, but you do actually see that there is a substantial number of households that are still borrowing more. Okay. So I am reaching the end of my story. I think just want to say a few things about concrete policy measures. So despite these policies that have been introduced, house prices have been rising after the introduction of the LTV, and even after introduction of the amortization requirement. We experienced this, a small dip in housing prices, and then house prices have started to pick up again. And the same holds for debt, essentially. Now, that raises the question, of course, what kind of policies can you conduct? And our point of view has been that, given the nature of the problems, the most important thing is to deal with the structural issues, like tax reform on housing, reduce the deductibility of interest rate deductions, and improve the functioning of the rental market, create more competition in housing construction. But if you want to look at the possibilities of macroprudential policy, we did a number of numerical exercises to see what the impact would be of different policies on household debt. And I can show you a couple of things. It's always hard to know how your graph is going to look when you're sitting in a big room. But I can say a few things that are interesting to know. So this red curve here, this is our calculation of what the impact would be of the amortization requirement that was introduced last year. And what we're looking at is, what is the impact of introducing an amortization requirement over the course of 50 years? And here on the y-axis, you see what will be the change in household debt relative to a baseline scenario. And basically so I won't call it a prediction. Our computation was that household debt would probably fall by only about 10% relative to baseline. If you look at policies that have a very strong impact potentially, you can look here. That's the red line here. That's the impact of abolishing the interest rate deductibility fully. If you want to look at a policy that's slightly milder, reducing tax deductibility of interest rates to 15% from 30% at the moment, that would have a long-term impact on household debt of about 30%. And then there's a number of other options here that you could do. So, but among these sets of alternative policies, the amortization requirement is a relatively weak policy. So, is there any hope for Swedish household debt eventually stabilizing? I think what we've been trying to say is that there are a lot of different policy options that people can apply. And the red curve here is basically our baseline scenario based on a monetary policy report and a number of assumptions about long-term growth that we made in October 2015. And our point that we're trying to make is that these different policies, LTIs, DTIs, LTVs, abolishing deductibility of interest rate costs, these things can be combined into packages. And if you want to achieve stabilization of household debt, then probably what we'll have to do is combine some of these packages, like introducing, we have already introduced the amortization requirement, but possibly abolishing tax relief on interest rate expenditures or introducing some kind of DTI limit. Thank you.